In 1975, a 26-year-old named Ray Dalio started a hedge fund out of his two-bedroom apartment in New York City. No outside investors, no institutional backing, just Dalio, his ideas, and a deep conviction that he understood how markets worked better than almost anyone alive. 50 years later, Bridgewater Associates became the largest hedge fund in the world. At its peak, it managed close to $160 billion in assets. It has generated more profit for its investors than any other hedge fund in history. But here is what makes Bridgewater genuinely unusual. The reason it is studied in business schools, debated in financial circles, and written about in major publications has very little to do with the money. It has everything to do with the philosophy behind it. Today, we're going to break down that philosophy. We will look at who Ray Dalio is, how he built Bridgewater, the radical ideas that shape how the firm operates, and what any investor can take from his approach, no matter how much capital they are working with. Who is Ray Dalio? Ray Dalio grew up in Long Island, New York, the son of a jazz musician. He was not a standout student. By his own account, school never really captured him. What captured him was the stock market. He bought his first stock at age 12, a few shares in Northeast Airlines, simply because it was the cheapest stock he could find. The airline got acquired, the shares tripled, and Dalio was hooked. He studied finance at Long Island University and later earned an MBA from Harvard Business School. After graduating, he worked on the floor of the New York Stock Exchange and then at a commodities brokerage firm. He was eventually fired from that job after punching his boss. That detail matters. Dalio has never been a conventional figure in finance. He has always operated by his own logic. After getting fired, he started Bridgewater from scratch. He began publishing a daily research note called Daily Observations, which he sent to corporate clients and policymakers around the world. The quality of his analysis built his reputation, and the firm grew from there. Dalio is also the author of a book called Principles, published in 2017, which became an international bestseller. In it, he laid out the operating beliefs he built Bridgewater around. Many of those ideas are controversial. All of them are deliberate. How Bridgewater Associates was founded. Bridgewater was founded in 1975, but it did not start as the kind of hedge fund most people imagine when they hear that term. In the early years, Dalio primarily provided macroeconomic research and advice to corporations. He was helping companies understand currency risk, interest rate exposure, and commodity price movements. He was a consultant before he was a fund manager. The firm grew slowly. By the mid-1980s, Bridgewater had developed a genuine edge in understanding global macroeconomic patterns, and institutional clients, pension funds, sovereign wealth funds, and endowments began allocating capital to it. Bridgewater's approach was always top-down. Dalio and his team looked at the entire global economy, the relationships between interest rates, currencies, inflation, and growth, and made investment decisions based on those macro views. This is called global macro investing, and it remains the foundation of how Bridgewater operates today. What set Bridgewater apart in those early years was the quality of its research and the rigor of its investment process. Dalio did not want opinions. He wanted models, principles, and rules that could be tested and refined over time. By 2005, Bridgewater had grown into the world's largest hedge fund. It held that position for nearly 2 decades. Radical transparency and idea meritocracy. If you ask most people in finance what they know about Bridgewater, the answer is usually not about the returns. It is about the culture. Dalio built Bridgewater around 2 interlocking ideas: radical transparency and idea meritocracy. Radical transparency means that almost nothing at Bridgewater is private. Meetings are recorded. Feedback is given openly. Performance reviews are conducted in front of peers. Employees are expected to disagree with each other, including with Dalio himself, and to back up that disagreement with logic and evidence. The idea behind this is that most organizations fail because people do not say what they actually think. They protect their egos, they avoid conflict, they tell their boss what their boss wants to hear. Dalio believed this kind of behavior destroys good decision-making. He designed Bridgewater to eliminate it. Idea meritocracy is the companion principle. It holds that the best idea should win, regardless of who has it. A junior analyst should be able to challenge a senior partner's thesis if the evidence supports it. The goal is to find the truth, not to protect hierarchy. In practice, Bridgewater implemented this through a tool they called a baseball card system, where employees are rated on dozens of attributes in real time, and those ratings are visible to everyone in the firm. Every meeting is documented. Every disagreement is logged. Many people who have worked at Bridgewater describe it as one of the most demanding environments they have ever encountered. Some have called it psychologically exhausting. Others say it made them better thinkers than anything else in their careers. Dalio himself has said the goal was never comfort. The goal was precision. The all-weather portfolio explained. One of the most important ideas to come out of Bridgewater is the all-weather portfolio. It is also the one most relevant to individual investors. The all-weather portfolio was built around a simple question. What kind of portfolio would perform reasonably well across any economic environment? Dalio identified 4 basic economic conditions that drive asset returns: growth rising, growth falling; inflation rising, inflation falling. Every economic environment is some combination of these forces, and different assets perform well in different environments. Stocks tend to do well when growth is rising. Bonds tend to do well when inflation is falling. Commodities tend to do well when inflation is rising. Treasury inflation-protected securities, or TIPS, hold value when real returns are being compressed. The all-weather approach is to hold meaningful allocations to each of these asset classes, sized not by dollar amount, but by risk contribution. The goal is a portfolio where no single economic environment can devastate your returns, because you are always holding something that performs well in that environment. When Dalio introduced a version of this concept to the public in a Tony Robbins book called Money, Master the Game in 2014, it attracted widespread attention. A simplified version of the all-weather portfolio became one of the most discussed passive investment frameworks in personal finance. The core lesson is not specific to hedge funds. It is about thinking in terms of economic environments, not just historical returns, and building a portfolio that can survive all of them. Risk parity, Dalio's core strategy. The investment strategy underlying the all-weather concept is called risk parity. Traditional portfolio construction tends to allocate capital by dollar amount. A classic balanced portfolio puts 60% in stocks and 40% in bonds. The problem, as Dalio identified it, is that stocks are far more volatile than bonds. In practice, the 60-40 portfolio has about 90% of its risk concentrated in equities. Risk parity flips this. Instead of allocating by dollars, you allocate by risk. You size each position so that each asset class contributes roughly equally to the portfolio's overall volatility. In practice, this usually means holding a much larger allocation to bonds, often leveraged, alongside equities and other assets. The leverage is what makes risk parity controversial. Critics argue that leveraged bond exposure can amplify losses in rising interest rate environments. Bridgewater's risk parity fund, known as All Weather, has had periods of significant underperformance, including during rising rate cycles. Dalio has defended the strategy's long-term logic, arguing that short-term volatility is the price of genuine diversification. Whether or not you use leverage, The underlying concept of thinking about risk contribution rather than dollar allocation is a genuinely useful framework for any investor. Bridgewater's track record and performance. Bridgewater's flagship fund, Pure Alpha, has one of the strongest long-term records in hedge fund history. Since its launch in 1991, Pure Alpha has produced average annual returns of around 11 to 12% before fees. During the 2008 financial crisis, when most funds were suffering severe losses, Pure Alpha gained approximately 9.5%. In 2010, the fund returned around 45%. Pure Alpha is a global macro fund, meaning Dalio and his team are making directional bets on interest rates, currencies, equities, and commodities based on their macroeconomic views. The fund has gone through periods of difficulty. It had notable losses in 2020 and 2022, but across 3 decades, the overall track record is exceptional by any measure. Bridgewater manages several strategies, including the All-Weather Risk Parity Fund, which is designed for stability rather than outperformance, and Pure Alpha, which pursues active returns. The firm's total assets under management have fluctuated as clients have moved money in and out, but Bridgewater has remained one of the largest and most closely watched hedge funds in the world. Ray Dalio's key lessons for everyday investors. You are not going to invest in Bridgewater. The fund is closed to most investors and requires minimum commitments that are out of reach for nearly everyone. But Dalio's thinking still contains lessons that transfer directly to how an individual manages money. First, diversify by economic environment, not just by asset class. Holding stocks and bonds is not true diversification if both are exposed to the same economic risk. Think about what each position in your portfolio actually needs to happen for it to perform well. Second, know the difference between volatility and risk. Bridgewater uses the word risk very precisely. Temporary price declines are not the same as permanent loss of capital. Understanding which one you are actually facing changes how you should respond. Third, test your beliefs. Dalio built Bridgewater around the principle that every investment thesis should be documented, tested, and updated when the evidence changes. Most individual investors hold positions based on conviction rather than process. The discipline of writing down why you own something and what would have to be true for that to change is one of the most valuable habits in investing. Fourth, stay humble about what you do not know. Dalio has spoken extensively about learning from his mistakes, particularly a major loss he experienced in the early 1980s when he confidently predicted a depression that never arrived. That experience shaped his entire approach to risk management. Is Bridgewater still the world's largest hedge fund? Bridgewater has faced significant changes in recent years. Ray Dalio stepped back from his role as co-chief investment officer in 2022, handing leadership to a team he had been developing for years. He officially stepped down as co-chairman of the board in 2023. The transition has raised questions about whether Bridgewater can maintain its edge without Dalio in an active investment role. Assets under management have declined from their peak as some institutional clients have moved money elsewhere. As of 2024, Bridgewater remains one of the largest hedge funds in the world, though it no longer holds the top position it held for much of the previous 2 decades. Man Group, Millennium Management, and Citadel have grown significantly and are now comparable in size. What Dalio built still stands as one of the most remarkable institutional achievements in investment history. Whether Bridgewater's second chapter matches the first is a question the next decade will answer. Final thoughts. Ray Dalio built something that very few people in finance have managed to build. A firm with a genuine, exportable philosophy. Not just a strategy that worked for a period of time, but a set of principles about how to think, how to disagree, and how to manage risk that other people have studied and applied in entirely different contexts. The specific mechanics of risk parity or global macro investing are not accessible to most people. but the underlying habits, thinking in economic environments, testing your beliefs against evidence, separating volatility from permanent risk, are available to anyone willing to apply them. That is what makes Dalio's story worth understanding. The money is impressive. The framework behind it is genuinely useful. If you found this video valuable, subscribe to Global Finance Watch for weekly analysis of the investors, companies, and ideas shaping global finance. We will see you in the next one.